Well, welcome to Investor in the Family Radio. I've got a special guest with me here today, Kirk Spano. Kirk, welcome to the show.
How are you doing?
Doing great. For any of you who have been listening to my podcast for any period of time, Kirk will be no stranger to you. We've done a number of interviews throughout the years, and always a good time. Always appreciate hearing Kirk's perspectives. Kirk is an investment advisor up in the great state of city of Milwaukee, state of Wisconsin. You still a big Brewers fan?
No, I gave up on them.
Oh, wow, man.
No,
man,
I'm
it
just
has been
kidding.
too.
Of course, I'm
man.
a big Brewers fan.
Well,
what's wrong with you?
Woo, hey, I'm the one who let out with it. Big Brewers fan, and he runs an investment service for any kind of a individual investor or DIY investor or professional investor looking for extra insights called Fundamental Trends. We'll hear about more of that later on as well. But I wanted to jump on interview with Kirk because, when things are happening like things are happening right now in the markets, this is April 3rd, 2020, and the last month has been, I mean, even if you go back 20 years, this last month has been remarkably unique. Even if you include the last two, the financial crisis and then the dot-com bubble. I mean, I think you'd agree this last month, even in the midst of those, has been very unique in terms of the extreme speed of movement of drops and just dynamics and otherwise. But in the midst of this, like everyone else, you're thinking, hey, how do we make sense of what's going on? What's some perspective? Maybe people are taking a 20-30% hit right now. What do we do with our portfolios? How do we move forward from here? All that kind of stuff. And so, Kirk, I'd love to, I'm just going to kind of give you a nice, huge softball pitch and let you just knock it wherever you want to go to get started. As far as with people looking for direction and perspective, where would you take them?
Well, I think that the first thing we have to start with is coronavirus. And what's going on with that, and how damaging can it actually be to the economy, and then by extension to investing from the stock market to real estate. I think that we start in the back of that and then come back around from the front to the back again. And what people need to realize is that we started this whole episode, this whole economic shock, during a period of time, which is going to last probably another decade, of slow economic growth, which we've seen for the last decade, tied to demographics, tied to global debt, tied to technology, and a slowing economy cyclically on top of that in the last several months before coronavirus. So we had the long-term secular trend of slow growth, largely due to aging demographics, ran into a cyclical slowdown that just began at the very end of last year. We saw PMI numbers fall in January. We knew that hiring had already slowed. The tax breaks were wearing off. The sugar high from that was wearing off. We knew that the economy had peaked. Well, 2 months later, rather than trying to figure out how to have a soft landing, we get coronavirus. And we've been slow to react to it because we don't understand it. But back on January 22nd, I had already been aware of coronavirus for about a month because I have some friends in China. And they had said, this is what's going on. And on January 22nd, I saw the first CNN article about it. And I tweeted it out. And I will encourage anybody who doesn't have a Twitter account to get a Twitter account and use it the right way, which is to get information from around the world. Because if you do it the right way and you connect with the right academics and analysts and media, press people from around the world, man, can you get information, ahead of the general population by not just days, but oftentimes weeks. And that makes a difference if you're an investor for sure, or if you just want to know what's going on in the world. But on January 22nd, I sent out a tweet. I said, this is the most important story in the world. Presumably, the government knew about it well ahead of me, right? So if I was hearing about it the last week in December, they must have been hearing about it sooner than that. Fast forward to February, and now we're starting to see what's going on, just starting to get a whiff of what's going on. I was in Puerto Rico for a couple of weeks in February, and we've got the very first news of it. And I was like, well, we better make sure we don't stay on the island too long. And we ended up leaving in plenty of time. It ended up closing about a month later. not many things got said about coronavirus in February that would make you think that it was dangerous, that it was something that could upend the world, right?
Well, and it's something that's going on over there, however you want to think about that. That's kind of how it's pitched, far away.
Right, and certain officials in the government, they downplayed it, which I don't think is particular to any one particular politician. I think most politicians do things like that when something serious happens. They try to make it okay, make it seem like it'll go away. So, I don't have any, malevolence to anybody. But, clearly this was a repeat of lots of things that have happened in history where first they tell us it's okay, and then we find out that it's not. Now we get into March, and things are getting serious. We're having toilet paper hoarding, which if it wasn't so serious, you'd really just laugh about it, right?
Which on a side note, it is really interesting that it ended up being toilet paper, and I was curious if that's like, if it's one of those things where like a few people did it and then it became a news thing and then it spiraled over everyone individual is thinking, wow, if this hits, I'm going to need TP. I'm just curious how that manifests itself, but we don't have to talk about it, but it's just an interesting way that's kind of become a cultural dynamic right now.
Right. Well, so interestingly, since the SARS epidemic 15 years ago, 16 years ago, whatever it is now.
2002, 3. No, 3, 4, yeah.
Yeah, so I
remember that. Yeah, go ahead. Yeah, go ahead.
I was going to say, I followed that research, and a couple years ago, they named what they were looking for, which is the next disease that would spread easily and kill lots of people. And they call it Disease X. So Disease X, very easy to transmit and very deadly in time. That is not what coronavirus is exactly. Coronavirus is very easy to pass, right? From person to person, pretty easy to pass. On average, if you get it, you've probably given it to 2 or 3 people. And that's why the curves are what they are for infection rates. And as we test more and more people, either for the current infection or after the fact when you go to the doctor and they test your antibodies, we're going to have a pretty good picture in the next 1 or 2 years of how many people actually ended up with this. And it's very likely that it ends up being around half of the population, which is just, right, should blow your mind. But herd immunity comes from about half of the population having gotten something, and then they become immune, and nobody's passing it on to each other anymore.
Right.
So the problem with this is that it's going to kill somewhere between 1% and 4% of all the people who get it. So if half of the people on the planet get it, so you say 3 billion or whatever the number is, it's going to kill 1%. That's just a monumentally huge number of deaths, right? So scale it down to the size of the United States. 330 million people. If 160 million people get it, you're looking at over 1 million people dying. And that is not something that we want to see happen. So,
and especially when it's 1 million people dying because hospitals are overwhelmed and crowded and hallways are packed, and it's not just people. I mean, people dying is bad enough, but dying in a way that is deeply traumatic, if that makes sense. I mean, I'm again not saying dying any other time isn't traumatic, but you know what I mean. Just like all the just kind of the chaos involved with it makes for even a more kind of graphic situation. Right,
and unfortunately, you generally die alone if you have coronavirus because you're isolated.
Mm-hmm. I know we have a friend who's, I forget what someone in their family, if it's an uncle or a grandfather, same thing, died alone with a nurse next to him because no family could be around them, and they can't really have much of a funeral either, or if they do, it's just a few people, and it's just, I mean, those are the things people don't actually think about. That alone is tragic. It's heartbreaking to think about that.
Well, and they're in Wisconsin anyway. They're ordering cremation.
Oh wow!
So you have to have a religious reason to not have a cremation, and if you don't have a cremation, there's hoops to jump through. So it's a serious thing. Now, if you go to the Johns Hopkins website, which I think is the easiest website to look at, go to Johns Hopkins.
I get their updates. They've got a daily update that goes out that I get that's really good.
And then the CDC and WHO, there's other places you can get good information. So if you really want to learn about this, don't take the link from some backwater website that somebody sent you on Facebook. Go to the CDC, go to the World Health Organization, go to Johns Hopkins. There's a few others. And what you see is a curve. So on Johns Hopkins' website, there's a curve on the bottom right-hand side. And what you want to do is click the logarithm button, because the first curve looks like a hockey stick, and it'll scare the heck out of you. But the second stick is logarithmic, and what it's showing you is the rate of change. And right now, we are at a point where for about 2 weeks, the rate of change hasn't changed, meaning that coronavirus isn't accelerating for infection, but it's not decelerating either. And what we have to do in the next 2 to 4 weeks is get that curve to bend over. Because if it bends upwards or even stays straight, we're in a lot of trouble. And the reason for that is there's only, and they can build more, but we're probably going to top out at capacity for about 200,000 people to have an ICU, a ventilator in the next couple of weeks. So if we have to have more than 200,000 people being treated, we're in a lot of trouble. A number that isn't getting publicized but is easy to look up is in Italy. They had that huge outbreak. Mm-hmm. And it was something like 11% of the people who got coronavirus died.
Yeah.
Largely for a couple of reasons. One, I'm Italian, and I can tell you, and it's easy to look up as well, a lot of multi-generational households in Italy, right? Grandma lives with you. So grandma was exposed. So that was probably something in your Bayesian mathematical model where you're trying to figure out an equation without knowing the exact inputs, and you have to use approximations. Grandma was there getting exposed, and that's probably why their death rate was 11%. But here's another number. The number of total deaths in Italy was 10 times higher in February this year than February last year. And that's because the healthcare system was so overwhelmed that people with other conditions couldn't get timely treatment, and they died too.
Well, and then there's all the people that potentially died of coronavirus at home and never were able to go to the hospital to get tested.
Right. Can you imagine if in April we had 10 times more people die in the United States than normal, or May? I mean, that would be just off the charts catastrophic. When I talk about the investments and the economy, I have to put on my analyst hat and glasses and talk about that. But we need to understand, and people who don't want to hear this need to hear this, we need to do the social distancing. There probably should be a national shutdown of anything non-essential for a solid month, if not 2 months. Because if this curve bends upwards, people who have things that shouldn't kill them will kill them. And the number of people overwhelming the hospitals and a system that's depleted of human resources, right? We just don't have enough doctors and nurses to keep working 100-hour weeks.
Right. Well, those are the dynamics in Italy. There's pictures and stories of videos of doctors who they're just working constantly, and then their health deteriorates, and it's just a terrible downward spiral of a place to be in.
Right. So, the population really needs to try to take this on themselves. And if you know somebody who's like, well, this isn't that serious and I don't understand it and therefore it isn't, you need to slap them across the back of the head and then back up 6 feet, because they don't know what they're talking about and they're dangerous. And people need to be told, there needs to be social pressure to tell people, look, go play a video game. Go sit on your couch by yourself. Go read 10 books in the next month that you probably should have read before. Just something. Because, and I hate to use words like this, the ignorance of the people who aren't taking this seriously, and I won't call them stupid, I just think they don't know what's going on, but the ignorance of the people not taking this seriously is very dangerous for everybody, from your kid to your grandma or your grandfather and your parents and you too. And out in New York, we're starting to get the statistics that it's fully a third of the people are younger that are getting this now. And they're getting sick too. If you're young and healthy and think you're immune, you better think again.
It's serious and it's scary. Yeah. I mean, I think when you hear about it, something that's far away and it doesn't seem, and you hear about the gravity of it and the scale of it, and we're taking all these precautions, and when you're still not seeing anything happen yet, it's easy to think, is this for real? It's easy to think, it's like someone living in Florida and being like, they always say a hurricane's coming, I mean, they've done this 15 times, we haven't got hit by a hurricane yet, so you think, I'm not leaving my house, and the hurricane comes, and so you kind of get into this situation where you just don't trust and you assume, oh, they don't know what they're talking about, they're over-exaggerating, but it's here, it's happening, and obviously, you mentioned, a number of dynamics coming together already. There's slowing economic growth, debt issues, demographic challenges. Cyclically, we were even slowing down. The economy was slowing down prior to coronavirus. And then coronavirus hits right at, say, perfect storm. But you have a number of things coming together at one time that led to basically a 30% drop in the S&P in, 3 weeks? Something like that?
Right. And it started going down again yesterday and today. So, my forecast is lower. I think that people should be prepared for much lower potentially. I've come up with a new acronym that I use with my subscribers, and that's FOGYAC.
Oh, yes.
So everybody knows what FOMO is, right? Fear of missing out, and that's people who want to buy the dip and get and buy stocks, right? Well, FOGYAC is a fear of getting your assets kicked. And I think that most people need a dose of that, because when you take a look at the support structures in place in the stock market and understand what's behind a stock price, which is the underlying business, which is impacted by their debt, which is impacted by their ability to repay their debt, which is impacted by revenues and earnings, you can see this stock market easily dropping another 15%, which I think is just about certain, to 25 or 35%, which I think is likely, potentially 60% further down from where we stand now. And I don't think that's likely, but it's definitely possible if that curve that we talked about earlier for the infections bends upward. And I hope it doesn't bend upward, but if it does, you better watch out, because at that point we're flirting with a depression. And that's just, there's no way to print your way out of that quickly. We'll get out of it, but it would take time. I don't expect the economy to be back to normal until the summer of 2022. Think about that. That's 2 years.
Right.
So and I'm not the only guy saying that. But I think that people need to understand what is truly going on. I've been lucky to a professor from San Diego. I have a geneticist who is a client, and he referred me over to another geneticist who had written a paper, and he described real simply how this all evolved. He doesn't make any predictions. He just says this is the general direction these things go, and you have a wide cone, right? Because we don't know all the details yet. So it's going to be bad, or it's going to be really bad. And our job is to keep it at bad. Because bad, we get over pretty easy. But really bad, think about the financial crisis in 2008 and 2009. People didn't get back to even for 6 or 7 or 8 years on their real estate and stock market portfolios. There's people who didn't get back to even until, 2016, 2017? And now it's happening again. So you need to be real careful about your risk levels. And my best financial advice to anybody is you really need to dial down your expenses from the standpoint of, are you buying any extras? And I know that's counterintuitive. If everybody did it, we'd have a problem. But you need to spend less as a percentage of whatever income you have than you did in the past. And I understand that a lot of people are going to have a lot less income. So, this is something that could easily spiral down. And ultimately, you can't be one of these people who says the government shouldn't bail anybody out or shouldn't print money. If we don't bail people out and don't print money, we're in a depression. So, just keep that in mind as you analyze these things and you try to decide, what should I do? Am I just getting started in life and I'm trying to figure out whether or not I want to buy a property soon? Well, if you're earning money, if you have a job where you didn't have to take off, right? If you're in IT or some job where you can work from home and still earn a living, and that's over half the population, you should be looking at this as an opportunity financially if you're still making money. Now, we could talk about the social impacts and everything else of a more bifurcated society, but from the standpoint of finance, if you have cash or are still generating cash, you should be saving up as much of it as you can short term, next several months, because sometime this summer or in the fall, you're going to have an opportunity to buy stocks, real estate if you want it, all sorts of different things. Because if you just line the dominoes up, you start to see the picture. There's going to be more deaths. That means more houses for sale. There's going to be fewer people who want to live in cramped apartment buildings, which means they're going to be moving out to outlying areas. And all this transition will take more time than the crisis took. So over the next several years, what should we expect to play out? A lot more people working from home. So that means less driving. That means less oil used. That means less office space being used. That means office rents go down. Occupancy rates go up. That means a lot of REITs are going to have trouble. Simon Property, the biggest mall owner in America, laid off 70% of their people a couple of days ago. Why?
Good grief.
Right. So what are they going to do to remodel those malls? They already had one model vision that they were starting to convert some of these malls, putting apartments next door and whatnot. How is American life going to change from this? And not just because of coronavirus, because now it's in the national psyche that the next one is coming. Disease X is out there someday. Someday there will be a virus that is this easy to pass on, or easier, and more deadly. So, there is a point where a virus is so deadly that it kills itself off, right? It just runs out of hosts. And generally that happens because quarantines take place and the population that doesn't have it never gets it. And that's like Ebola or SARS. Those were so deadly that once we identified it, it was easy to contain it. Now, the first people who got it, they died, but it didn't get passed on for very long. And that's why anytime Ebola pops up in Africa, and it may never pop up again because we figured out what we have to do, which is, you have to have cremation. In Africa, where Ebola was happening, they handled the dead bodies. They basically passed them down the street to the funeral, to the gravesite. Well, people were getting Ebola from dead bodies.
Right.
So, once we figured that out, okay, now we know some things. Don't handle a dead body unless you're prepared for what you're touching. 2, wet markets around the world need to go away. China says they're working on it. I don't trust China, but let's hope they get to it.
And the reason we bring that up is because wet markets, that's where you've got like the fresh meats and all kind of stuff for sale on the big markets, and that's where a number of these coronavirus type things like SARS and the current coronavirus, it's understood that most likely those viruses kind of leapt from animals to people, most likely in environments like that, because it kind of creates a much higher probability of transferring a disease from an animal to a person. That's basically the idea behind that, right?
Right. So we know at this point that this coronavirus came from a type of bat, and somehow the bat got it to another animal, and then we ate it without cooking it all the way through or something. I don't know. But, there's parts of that puzzle we don't know how it got from the bat to the human, but somehow it went through the food chain and got to us. Wet markets in general are a bad idea. They're not clean everywhere in the world. Back in college, I worked in a meat processing plant, and I'll tell you what, that place was spotless. I mean, it was spotless. 3 times a day we made that thing spotless, and sanitized it. A wet market, I mean, they just chop something up on a table there and they give it to you. And there's a certain level where that's okay if you get the first piece. But what about all the things that mix? So yeah, humans do stupid things. So we have to get over some of the stupid things that we do, because we're going to get another one of these. We just know that it's going to happen. And we're going to have to be prepared. So going all back to me following SARS years and years ago, the funny thing is I always keep a ton of toilet paper in my house, because I knew that someday we'd get locked down for 2-3 months, maybe a year. And, this is going to end up being 2 or 3 months probably, because there's a very strong likelihood that the summer weather is going to really make it difficult for the virus to survive, because ultraviolet rays tend to kill these types of viruses.
I hope so. I've got a friend talked to this morning who has spent a lot of his life in Ecuador, and apparently it's pretty hot down there right now, and it's a very, very present. So hopefully, I hope you're right, but yeah, we'll see. But I hope you're right.
Yeah, and we don't know that that's the case with this one, right? Maybe it's not like the other ones. Maybe this one doesn't care about ultraviolet rates and humidity. So that's what we have to figure out is, will the sunshine help us? I don't know what the early signs are yet. I haven't seen anybody say definitively, because I don't think anybody knows yet. But as an investor, I take a look at all this, and I worked through the financial crisis. I called that one. I was doing seminars in 2007 telling people to sell their second houses and sell their stocks. And I had clients fire me. They told me I was nuts. In 1999, I was telling people to sell their stocks, and they fired me. They told me I was nuts. Well, I told people in December, January, and February to sell their stocks. And on February 28th, I do a webinar every Friday morning. I told everybody, when we're done with this webinar, go and sell some things. And I had up the people who listened to me 75% in cash by February 28th. Now we're looking at what to buy. And I just put out an ETF chart book. We have about 10 ETFs that we're looking at buying at certain levels. And right now they're at the first support level that I think it's gonna go through. And then there's a second level, and then a third level, and then a massive decline level. I don't think we have the 60% drop from here, but I think 25 to 35% is pretty likely. So there are certain investments that you'll want to make. And the thing to keep in mind is that if a particular investment class wasn't doing well in the last couple of years, do not expect it to do well in the next couple of years. So you want to gravitate towards all the things that are in what I've been calling for 3 years now on one of your webinars, I believe, one of your podcasts, where I said you want to invest in the smart everything world. This was back when Stanley Druckenmiller, one of the greatest investors of all time, 30% returns for like 30 years in a row, and a billionaire, said, look, invest in the disruptors, not the disrupted. So you want to invest in technology. You want to invest in consumer discretionary favorites. You want to invest in industries that are adapting and have invested in fourth industrial revolution technology, machine learning, artificial intelligence, robotics, things like that. It's important that when you build your asset allocation, don't just buy the S&P 500, because I'm going to tell you right now, over 100 companies in the S&P 500 are zombies. They're never going to recover. And it's going to hold that index.
Yeah.
The S&P 500 return this decade that it did in the 2000 to 2009 decade, which was about 2% a year. He collected the dividend, and that was about it. But my research showed before coronavirus that somewhere in the range of 100 to 150 companies in the S&P 500, they weren't growing revenue. They weren't paying down their debt. All they were doing is skimming money to the executives through bonuses. Now those companies are in big trouble. Because
they're doing stock buybacks.
They were doing a lot of stock buybacks. And with lower revenue, we already know, another article I wrote, that the buyback bubble would end badly, is happening right now. Companies are no longer buying back their stocks. And I showed a chart about this today in my webinar. So if you want to find me on YouTube, it's there for you to look at. The underlying buyer in the stock market the last 4 years has been the corporations themselves.
Yeah, that's
They've been the marginal buyer. You worked at a hedge fund, you know that.
right.
So if the marginal buyer, right, the one that pushes prices up, no longer exists, what direction do prices go?
Well, if you run out of buyers, nothing's driving the price up anymore.
That's right. So, I use an indicator called Chaikin money flow, and it basically tells you if money's going into or out of an investment. If money's going into an investment class, the price will generally go up. Money's coming out of an investment class or company or industry, whatever, price will go down. Very simple Econ 101, supply and demand. If the demand for something goes down, the price for something goes down. You can track that by seeing how much money is flowing in and flowing out, and we have a way to measure that.
Right. So if people right now, if they weren't following you back in February or weren't paying attention one way or the other, and they didn't move to a heavily weighted cash portfolio, 70% or any other number there, and they're looking at their portfolio and they're down 30% and change, it's been up and down a little bit last week or two, but they're hurting and they're like, for whatever variety of reasons, they are where they are. And everyone's thinking, hey, I think for a little bit, people have been thinking, oh, well, I want to make sure I want to take advantage of this drop in prices to buy before, stocks jump back up again. Q4 2018, we had that classic V bottom. It went down and it skyrocketed back up for, 4 or 5 months. People had a terrible 2018 and a remarkable 2019. I think you can see a lot of people were looking for that and they're afraid, hey, I don't want to miss the bottom. I don't want to miss this opportunity, but you get into the situation of, how do you invest in a bear market? And, should people still be looking to sell some stuff in their portfolio, or is it too late to do that? And when do you think it's aggressive to start buying? And obviously, I'm sure you're still playing some of the details out. You don't have all the answers, but I'm curious kind of how you're thinking about some of those things. You mentioned late summer, early fall, could be a good opportunity to become aggressive. What are some of your thoughts as far as positioning today overall in terms of a portfolio and strategy and things like that?
I don't think it's too early to sell your losers. And by losers, I don't mean they went down in price. I mean that the underlying businesses are losers. So if you have an asset allocation, you own stocks and funds and whatever you own, you can rotate into better stuff.
Right.
Right. So if you own the S&P 500 and you don't want, and you're worried about being out that one day when the market goes up 5%, at least switch from the S&P 500 over to the Triple Q, which is the Invesco Triple Q NASDAQ 100 ETF.
Yeah, if you're gonna lose money, at least lose money in something you want to own.
Right. And so if you have to rotate your asset allocation because you're afraid of actually being out because you're afraid of getting back in, then just switch. Switch from stuff that's not as strong to things that are stronger. Upgrade asset allocation. And the easiest thing to do is to get non-correlated to the S&P 500 and get correlated, right, to the NASDAQ 100, which is Apple and Google and Amazon and Facebook and Netflix and Amgen and Biogen and Comcast, right down the list. Those are the real blue chips in the economy. The companies in the NASDAQ 100, think this through as I say it, have 70% of all the cash on corporate balance sheets today. Out of thousands of companies, those 100 companies have 70% of the cash of all companies listed in America.
Well, the top 10 probably have 50.
Yeah, well, yeah, it's the top. Yeah, like the top 20 have 50, right?
Yeah.
So so you want to be invested in the companies that are profitable, look like they'll be profitable for another 5 or 10 years at least, and you're getting a chance to buy them on the cheap. And when I say on the cheap, just cheaper than they were before.
Right.
The stock market, as of today, Friday, April 3rd, is not undervalued against earnings. It's about fairly valued if we're very, very generous about what earnings will be next year. Based on what I think they'll really be, stock market needs to drop 25 to 30%. And I think that people will eventually get scared enough to sell. Yeah, now, I hope that things smooth out, they don't get so bad, but history shows that people panic.
Right.
So either you need to sell before them, or at least switch into the better investments.
Right. But at a minimum, It sounds like you're pretty clearly saying this is not the time to be aggressive in trying to capitalize on the drop in prices.
No, I mean, there are definitely companies that you can cherry pick, but go back to Jim Rogers. Jim Rogers said something when they asked how he became such a young billionaire. 37 years old, billionaire, he retired. Used to be a partner of George Soros. He said, look, I was on a subway. It might have been an airplane. I might have the story a little mixed up. But he was traveling to New York, talking to some guy who was an investor somewhere. And Jim said, well, so what would you tell me is the most important thing that I need to know about investing? And the guy said, look, read everything. Read the corporate documents. Read the corporate documents of their competitors. Read the industry reports, the industry magazines. Find out what people who use the product as professionally are saying about it, or the service. Get what's called the scuttlebutt. That's from a book, Common Stocks and Uncommon Profits by Irving Fisher. And that's something that Warren Buffett cites all the time. If you can cherry pick some of these stocks because it looks pretty good, but you understand that company because you did the work, you did all the research, not 2 hours on the internet, but you really did the research. You dug into this company and you could go there and work in management. You can pick out some of those stocks, but don't be one of these people who says, well, it drops, so it looks pretty good, I'm going to buy it. Right. Whatever. You deserve to lose half your money every time you do that. So, because guys like me are going to take it from you because you'll make a mistake. If you truly like where you work, you might know something about a product that you use at work. Start there. Start with the things that you know deep down inside how they really function, how these markets work for this widget or that thing. That's a good place to start. And I will tell you, in any growth industry, there are good products that are driving stocks up in price. And if you're in an industry that has some growth or at least change, like the utility industry, not really growing, but a lot of change, you can find products from companies and you go, I'm going to check out that company. That's a pretty good place to start. Don't just say, oh, GE is down from 60 to 6. I should probably buy it. Well, you know why it went from 60 to 6? It deserved to. I've been telling people for 3 years GE probably goes bankrupt. So that's where we need to start. Is you can cherry pick stocks, but otherwise wait to build yourself a better asset allocation.
So right now it sounds like, one, it's not too late. First of all, if people are at a place of like, figuring out what do I do at this point? I've been hit by 25, 30% loss in my portfolio, saying, you know what? It's not too late to sell your losers and rotate that money into stronger names. And, may even want to keep some of that money you've sold in cash to buy those names at lower prices. So, maybe you spend half that money on buying better assets to keep the other half for maybe, buying 5 or 6 months from now. Obviously the timing, we don't know the exact timing at this point, but it sounded like now's the time to be repositioning yourself and preparing for the chance to potentially get aggressive, 4, 5 months down the road, something like that. Is that kind of where you're at?
Exactly. And I'll just point out, my most aggressive portfolios still have 35% in cash, and my most conservative portfolios have 80% in cash.
Gotcha.
Which is the highest that I go. This is not something to think is just going to pass easily. Take a look at what happened from autumn of 2008 to spring of 2009. We're probably going to go through something like that with more waves on the way down.
What about people thinking, they want to hedge their portfolios with, inverse ETFs or puts or something like that? Is that something that you think is wise now, or is that maybe getting a little bit too aggressive trying to capitalize on the down?
So I trade options, but the guy who taught me actually helped write the test that brokers have to take to trade options. So I have world-class training. And I think that trading options is hard. Inverse ETFs and leveraged ETFs, unless you are a technical genius, should never touch them, because you are competing against the best traders in the world, and you probably don't understand that the way that those vehicles work using underlying futures contracts means that from day to day, the trade might go in your direction, but you might not make money, depending on how those futures are set up. In my opinion, unless you are a highly skilled day trader, because you can't hold any of those vehicles more than a day or two, unless you are a highly skilled day trader, you truly understand the quantitative and technical ideas behind how to trade, you should not do it. Those are super dangerous vehicles. You can lose a lot of money fast. And if you do end up doing options, which are a little easier and a little more fairly priced, understand that you make very small bets. Never put a lot of money, right, on one horse. Have a lot of cash on the side and make small trades until you get better at it and you truly understand the dynamics of what you're doing. People who trade, I know there's a lot of younger investors out there trying to trade these inverse ETFs. And I'm just telling you, back in 2008, I bought the inverse bank ETF and I traded it all right, doubled or tripled my money into certain accounts. But if I had held on just a few days longer, either of the times I traded it, I would have lost money because the market moved that fast and those ETFs destroy you quickly if things go against you.
So even the non-leverage inverse ETF, like a just an inverse Russell, for example, was it IWM or TWM? I forget which one it is. Like this not leveraged at all. So you think those even we're staying away from?
Yeah, because they reset every day, which means that there's new futures pricing. And if the futures market is in something called contango, right? If you don't know what contango is and what backwardation means, you shouldn't be trading these vehicles. But if that market is in contango, it resets at a lower price. So it never works in your favor. You always have to be in a backwardation situation to make these ETFs or options or futures work for you. If you're in contango, you're in a lot of trouble if you hold overnight.
Gotcha. Interesting. So in summary, if someone does want to hedge themselves a little bit right now, you would recommend buying put options and not buying inverse or leverage inverse ETFs, and to be very, if it's new for you, to be very, very sober and take tiny little steps to get in the beginning until you get a better feel for what you're doing.
Well, and in reality, if this is new to you, this is not
options trading. Yeah, gotcha.
But this is not the time to train if it's new to you.
Gotcha.
Train when everything's going up and it's easy and the market will bail you out when you screw up. But, I just bought some puts on SPY, and I just bought some puts on IWM, but for a 2-week time frame. This is a 2-week trade. And that's really, you don't really want to go any longer than 2 months, but I'm doing 2 weeks because the options were cheap, and I think the next 2 weeks are going to go straight down. By the time you listen to this, maybe everything has changed. So you don't want to train on any of these exotic vehicles. The very best hedge right now is to hold a lot of cash and wait for a good opportunity to put it to work for you on the long side. Short investing is for professionals, and if you're not a professional, you better be exceptional, because you're competing with professionals and you're competing with supercomputer algorithms and big institutions. Just understand. I mean, it's like being a junior high football kid and the all-star on the team, and then you go to try playing the NFL. You're going to get run over and stomped on and hurt. So if you're a 7th grader trying to play in the NFL, get your mind right. You shouldn't be out there with those big boys.
Well, Kirk, hey, we appreciate your time, and it's helpful, just kind of walking through, and you spent a lot of time digging into the coronavirus, going back to January, kind of hearing some broad level perspective as far as what's going on there and kind of how that's affecting market or how affecting the economy, and then therefore how that's affecting investments in the markets. And, really appreciate your thoughts toward the end here as far as, what are some action steps people can take now as far as repositioning portfolios if necessary, and what wisdom says to do now in terms of buying, selling, repositioning, and kind of what to be waiting for. So thank you so much for taking the time with us today. And obviously, anyone if you're looking for learn more about Kirk's work, again, you can look for it at fundamentaltrends.com. That's fundamentaltrends.com. I'm sure if you Google Kirk Spano, Spano, you'll probably find it pretty easily as well, I'm assuming. But fundamentaltrends.com, and you go up and get a free account there to learn a little bit more about what's going on. I think he's got a quarterly report or outlook coming out this weekend that he'll be making available for free as well for anyone who signs up for his free level of his service. And he's got several other options available too in terms of people who want to work in ETFs or stocks or otherwise, or a combination of the above. So please go check out Kirk's work there. But Kirk, again, thank you for your time. And as always, is very insightful and enjoyable.
Yeah, thank you very much. And congrats on baby number 3 on the way.
Hey, I appreciate that. Yeah, we're really excited.
Very good. All right, take care.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.